Thank you very much, and pleasure to be with you all in a cyber sense, I guess. Obviously, we're all learning new skills, and I think trying to make the best of a very difficult situation. And I think from the UN, I can certainly extend our condolences to all those who have been suffering either the health impacts or the economic impacts of the current pandemic. We certainly need to double down in so many dimensions linked to the sustainability agenda if we are to better manage our global commons, including certainly the interface between people and nature. So I'm very happy to have the opportunity to close this 3-day conference and to share some perspectives from the UN with you. So yes, I head the UNEP Finance Initiative, and we have various programs essentially working with the financial sector. What we would think would be to support a more nuanced understanding of environmental risks to business. And I think also more importantly, how the financial sector can positively act on those risks, turning them not only into opportunity, but positive change for society and the planet at large. Over the years, we've created a number of what we believe are very important finance sector frameworks for defining the norms for responsible conduct, essentially. Back in 2006, with the Global Compact, we drafted the Principles of Responsible Investment, was probably the best known of these frameworks. And today, as you probably know, they're headquartered in London. I have the pleasure of being one of the 2 UN members on the board alongside Sandow Jambo from the Global Compact. It's made great progress and continues to do so as it really engages a very large part of the investment industry. 6 years later, we work with a group of insurers to draft the Principles of Sustainable Insurance, and that's for insurance underwriting, which also has seen a good uptake. And then most recently, I would say the biggest development ever we've been involved with was the drafting of the Principles of Responsible Banking, which launched almost exactly 1 year ago in New York by UN Secretary General Antonio Guterres and 130 founding banks. Today, there's 190 banks who are signatories. They represent about 40% of global banking assets. And interestingly, I think along with the times, particularly in what we would call the post-2015 world, where we have the SDGs, we have the Paris Climate Agreement, if you look at the PRB, we've really shifted from the notion of risks to that of impacts and alignment, from processes to outcomes. Processes are important, but at the end of the day, we need to be measured on outcomes, not just that we have certain positions filled in our hierarchy or that we're checking certain boxes. It's essentially what are the results of these efforts. So no longer, I think, is impact of investing a niche. Rather, it's starting to take hold in some of the largest institutions, and that's what we've been hearing in the last couple of days. And just now, the session that's just finished up, one of our most exciting endeavors, the Net Zero Asset Owner Alliance, that we're very pleased to co-host with the PRI and a really dynamic group of investors. There, the focus is on carbon emissions reductions, but even if we've heard from them, it's a wider, we need to be both focusing on laser focused on issues about how do we get to net zero, and then of course how do we also start to eventually look at the wider impact, for instance, in achieving the Sustainable Development Goals. I think importantly in today's context, this certainly includes, as I mentioned earlier, a really wide remit, including health and social issues, gender, race, poverty, and the digital divide, as we make use, or as we more and more look to be using digital means in how we do business. This type of more holistic approach, we believe, and I think many believe, I assume most of you believe, is critical to achieving a business-driven impact agenda and essentially to be able to achieve the SDGs. And this was a conviction that we started to really develop in 2017. We started to build out this notion of positive impact, really with the idea that it is a holistic approach to impact analysis and management within mainstream finance. And this work we define positive impact, business and finance as that which contributes to one or several of the three pillars of sustainable development once any negative impacts to the three pillars have been duly managed. Now, this predates, but certainly has similarities to the EU taxonomy and is the bedrock as well of the principles of responsible banking. We've been developing tools for impact analysis for mainstream finance, most recently a corporate impact analysis tool for financial institutions to work with clients in investee companies, and a portfolio impact analysis tool, which enables banks to assess their entire loan books from an impact perspective. We're also really pleased to be part of the world's global standard setters working with the global standard setters on impact analysis through what's called the Impact Management Project. I'm sure many of you are aware, essentially working towards building some global consensus on how to manage and measure impact. Governments are taking note of this growing interest. Investors signaling a growing interest in impact investing means that governments can take up blended finance, for instance, and as we know, state and local governments started to feel the pressure to do more with less. It provides room for foundations and private investors who are increasingly willing to support through their impact investing efforts. However, linked to enabling frameworks and possible barriers, I'd like to take a moment to speak about investor duties or fiduciary duties within common law jurisdictions. So going back into ancient history a little bit, back in 2005, our asset management working group commissioned a piece of legal analysis, later became called the Freshfields Report, that considered whether investors could take ESG and other long-term issues into account in their investment decision-making. Now, this landmark report was really a watershed moment, and it led to the establishment of the PRI and the understanding that investors indeed could consider ESG risks and not be breaking their fiduciary duties. We continue to work on this over the years in partnership with the PRI as it grew up, and the duty to consider ESG risks shift from a could to a should to a must in many jurisdictions, and certainly within the European Commission, the EU Action Plan on Sustainable Finance, fiduciary duties are very well situated, and there's some, I would say once again, milestone moments in terms of how they are integrating it into the legal context within the European Union. Interestingly, there has been some pushback in the US from the current administration, and investors have been the ones who have actually been defending the need to take ESG into account on a purely materiality basis. So what's this got to do with impact? A lot, as I'm sure you're aware. And fiduciary duties could really be what prevents mainstream investors from really getting engaged with impact investing. So with the PRI and Generation Foundation, we've initiated a new program aimed at the development of a new legal framework for impact. And the case being made is that assessing and accounting for the sustainability impact of investment decision-making needs to be a core part of investment activity. Despite significant advances, we feel that capital markets continue to operate beyond sustainability boundaries. I think that that's clear, but maybe not yet in a legal basis. And that sustainability impact is a new frontier for investors and policymakers. So basically, it's become increasingly clear that the old incremental approach of ESG integration, although important, it's not enough. I'm assuming that many of you will agree with this. And I think investor and finance sector leadership is really demonstrating that this is feasible. We're seeing so many examples of that, including in these days. Setting targets for sustainability impact and delivering on those targets is the new frontier, Paris alignment, net zero, etc. Therefore, we need really to embrace a new economic and regulatory paradigm around sustainability impact. This can't be a sidecar. This needs to be central to how the investment business operates. And we believe that the regulatory framework to move beyond impact is needed to get beyond purely the ESG focus for the real integration of sustainability impact. We believe this needs to happen at three levels of disclosure, process, and duty. And in the coming weeks, we are actually going to launch, again with the law firms Freshfields, what's called a legal framework for impact. And that's going to identify leadership areas that demonstrate how legal frameworks, and looking at 11 different jurisdictions globally, how they are and can be supportive of investing for sustainability impact across the board. It's also going to consider where there are legal barriers. And as we know and see in many jurisdictions, the law has not kept pace and currently is not really fit for purpose in this area. Lots of work needs to be done. We're super enthusiastic about the EU's consultation on renewed sustainable finance strategy, which specifically makes reference to this issue and development that's needed there. So taking account of the vast regulatory landscape, this report will provide, we hope, a series of recommendations to update legislation to foster a more supportive environment for investors, to support sustainability impact, to incorporate it in their investment decision making. So just finally, I would like to leave you with one last thought. We see an increasing public awareness and concern over the increased concentration of capital. I know many of you speak to this. Thomas Piketty, for once, his work, or for as an example, has really demonstrated how impactful this can be on equality. Serious impact investors, I think, will all agree that the rate of return on capital has outpaced the rate of return for labor. And meanwhile, the cost of financial intermediation is prohibitive in many areas or regions around the world where it's needed most. So we really believe that truly sustainable impacts really require investors to address this challenge, this one of economic equality, head on. And then to line that up alongside our efforts to address the climate challenge, to address all the sustainable development goals. We need leadership. We need government to take action. We need signals between leaders in the industry and governments to create the enabling environments, to create the duties, to create the beliefs and the expectations, so we can get there in the long run. With that, thank you very much. I'd be happy to take any questions.